Hello, this is Brett Rentmeester at Windrock Wealth Management. Thank you for joining us for our presentation on investing in U.S. farmland, why farmland is not overvalued. Before we dive in today, we wanted to provide a quick backdrop of what we see as the three legs of the farmland story. There's obviously the unique opportunity today in farmland itself, putting aside any of the big macroeconomic forces that benefit it. And largely, the story here is a very fragmented mom-and-pop industry that's ripe for opportunity. Along with that, however, are macroeconomic conditions that we think, looking out, the next couple decades, are very supportive of farmland prices. On the demand side, which we'll dive into this, I'm sure, today, the world's likely to grow by about 3 billion people over the next 35 years. On the supply side is the reality that arable farmland growth has been essentially flat the last 30 years. And then we've got the reality of water scarcity on a global basis. And the third component, which is really a wild card, is our belief that inflation is not priced into markets today, but remains a very valid threat looking out over the horizon. Food's a necessity good and often a first responder to inflationary pressures. So today we're going to look at the unique opportunities in farmland and discuss some of the macroeconomics. And I want to introduce our speaker, Hunt Stuckey. Hunt is the Director of Research and Investment Strategy at Ceres Partners. Ceres owns approximately 150 properties, farmland properties, which equates to about 50,000 acres across 6 states. And they serve as the landlord and have a model where they partner with 33 tenant farmers. Hunt is active in market research efforts, farm acquisitions, and has been a leading voice across the agribusiness global supply chain. So Hunt, thanks for being with us today.
Brett, thank you for having me.
Let's jump right in. Farmland has been a good investment over the last decade. While we've seen equities and global financial markets falter, the mainstream often equates this rise in farmland value to overvaluation. We'd like to take this whole presentation, but take us through your thoughts on why farmland's poised to be a good place to invest looking forward.
Sure, Brett. And it's natural when you have an asset class that's performed as well as farmland has, especially against the backdrop of the last few decades, for people to ask if it's overvalued. Our view is that the fundamentals not only support current valuations, but in fact that farmland remains undervalued and that there's appreciation potential left here. But let's explore that. Now, before we can really talk about valuations, we want to understand what's driving the commodity markets. What's driving them is people rising out of poverty, in the emerging markets, and especially in China. Now, for someone living on $250 per day, improving your quality of life means essentially eating better. And at $250 a day, eating better means more animal protein, means more beef, more pork, more chicken, and more dairy. And producing more animal protein requires more feed, requires more corn, more soybeans, and more wheat. So I think these statistics on these pages are absolutely staggering, certainly for those of us fortunate enough to be living here in the U.S. and in other developed countries. There are approximately 7 billion people on the planet today. Of those 7, 4 billion of them are living on $5 a day, $1,800 a year and less. And close to 3 billion of them are living on $250 a day or $900 a year. Now, in China alone, there are 900 million people, so about 2/3 of the Chinese population, and roughly 3 times the population of the United States, who are at that $5 a day and below level. Now, to me, that's just staggering. And as those people's incomes rise, and they will demand, first, more animal protein. And this happens before they demand a cell phone, before they demand any of the consumer good. They demand better food, and that's where their incremental dollars go. So I think what's important here, what's exciting for us as investors, is this is not a demand story that's going to last a couple of years. This is a demand story that is going to last for decades. And by the way, it's not just about China, but China happens to be on the cusp today, so that's where we're seeing demand come from.
Great. Well, and I think, as you're saying, it's coming from two directions. It's the growth in population ahead, more mouths to feed, but just as importantly, it's changing preferences for food. How do we think then, if given that as the backdrop, take us through some of the fundamentals then in the farmland and commodity space as you see it?
Right. So let's talk briefly about the implications for the agricultural commodity markets, and then we'll talk about farming and farmland. Sort of, we start with peasants in China. Now let's talk about commodities and markets and farming. First of all, this demand growth is already happening. This is not something that we're projecting is going to happen. We're in the early innings of it, but it is absolutely happening. And demand has been growing, and we project will continue to grow at approximately twice the rate of productivity. And productivity in agriculture is measured in bushels per acre. And what was happening up until about 2006, 2007, we had plenty of supply, and we had healthy buffer stocks globally of all these commodities, and they were able to absorb any supply interruptions. In agriculture, those interruptions are generally caused by a drought somewhere in the world, although they can be caused politically as well. During this time, corn traded in a range of between $2 and $3, and we're going to look at corn today just as a benchmark. So if there was a drought somewhere, prices would spike, but then they would quickly revert to that $2 to $3 range as the buffers got replenished. Now around 2006, 2007, we ran out of buffer stocks. The cupboards are now bare. So we can only consume what we can produce in any given year, and prices have risen in order to clear the market. So these tight supplies have led to high prices. And the problem is we don't have enough capacity to replenish the buffers. So this has set up a new normal in pricing. And prices are bouncing around between about $4.50 and $7.50. At $4.50, just is a price at which we start to lose acres globally. So if you go to major producing areas in, say, Brazil, at $4.50 corn, it's not worth producing. By the same token, when we get $7.50, and we saw this back in 2012, that's a price at which not only is it worth producing, but it's actually worth opening up additional acres. So we have acres in the world, but it requires that high price signal for people to go out and convert pasture land into farmland to grow crops. So this is the new normal that we see. You see prices bouncing around between $4.50 and $7.50, and it will bounce a lot. It will be highly volatile, but we think they're going to average somewhere in the middle, call it around 6. And that has big implications for farming and for farmland.
And Hunt, what does this mean then for the average farmer? Why don't you take us through what the world looks like, from a farmer's perspective?
Sure. I think what's important here is to understand is that farmers today are making a lot of money. They don't flaunt it, but farmers are making a lot of money. And this graphic shows the profitability of a typical Midwestern U.S. farmer on a corn-soy rotation. So in other words, they plant half his fields in corn and the other half to soy each year, and they switch in the off years. And this is USDA data. What you can see here is for about 30 years, these farmers averaged contribution margin about $70 per acre. You can also see is that since 2006, they've been making way more than that. And the red line on the graphic, which I think is the most important because it's a 3-year trailing average, shows that they've been averaging almost $300 for the last 3 years. And that's after operating costs and rents have gone up significantly. So farming has become very lucrative, and you have a new generation of farmers, and they want to expand their operations. And look, farming economics are pretty simple. Now, there are scale advantages and everything else, but easy way to think about it. every 100 acres is about another $30,000 in that farmer's pocket each year. So if they want to clear another 30K, that farmer's got to go out and find another 100 acres to farm. So if they want to expand, they have to compete for more acreage.
And Hunt, I mean, why don't you describe, yeah, I was going to say, why don't you describe your model of being kind of a capital partner to farmers and how that model is set up to help them accomplish that?
Sure. You know, farmers are amazing entrepreneurs. They're family businesses, and they are highly entrepreneurial, and they recognize that their capital is better spent supporting the farming operation, buying or leasing a capital equipment, buying seed, buying fertilizer. That's an expensive, capital-intensive business. They may make $30,000 on an acre, but it probably costs them $600 to grow that corn, the corn on that acre. So they need to invest all that capital, and they want to use their family's capital typically to expand their operation. Now, every farmer owns land, likes to own land, but they want to farm a lot more acres than they can afford to own, and that's where we come into play. We identify, and we've identified 30 of what we think are some of the finest farmers in the country, and we're partnering with them to help them grow their family's business, providing the balance sheet to let them, or will own the farmland, take a rent from them, and then they are farming it. It's very similar to, someone with a mall, not a retailer, they're a mall operator. We're not farmers, we're farmland owners.
I'm reminded, too, looking at this chart by visionary investor Jim Rogers, who in almost every presentation he gives these days, telling young people, go into farming, don't go get your MBA. So he sees a real bright future as well. Let's turn the discussion a little bit to the investment implications of all of this. I mean, obviously, we've been in a very strange world, especially since '08, where we've seen extreme policy measures of 0% interest rates and literally trillions of dollars invented out of thin air around the globe. And yet we have record low interest rates, so making money in bonds going forward is going to be very difficult. We're sitting near all-time highs, at least in the U.S. stock market, so it's hard to argue stocks are cheap. How do you see farmland stacking up when you look at values today?
We think farmland is really attractive relative to other asset classes for a number of reasons. First of all, as we talked about already, farmland valuations have been driven not by interest rates, but by farmers making more money and wanting to expand. And it's those economic farming profits that have been driving farmland values. What this graphic shows is that on investment grade farmland, the cap rate, for those on the call who aren't familiar, cap rate are the real estate equivalent of a bond yield. Cap rates have actually been flat for about 8 years now, at about 4.25% plus or minus. What that tells us is that farmers are paying rent. Land may have gone up a lot, so has farm rents. Farmers don't sign on to rents they can't make when they can't make money. So they're still making these great profits after rents have gone up a lot. So we don't think this is being driven by interest rates. We think it's being driven by fundamentals. And looking forward prospectively, we think as you look at farmland going forward, in a $6 corn environment that we forecast, we think there's probably about broad market, about 5% annual appreciation over the next decade, give or take. Now, when you add that to add the income to that, when you add value add that a good farmland manager that we've historically been able to bring for our clients, we're able to deliver, we hope, a double-digit real return over the next decade in farmland. And again, it's made up of a combination of market appreciation, value add, but also big, strong current income that comes from rent.
And Hunt, you know, I think the other thing that you and I were talking about before this interview that's of interest is you guys are value buyers. Can you talk about the auction history of what you're seeing out there in the market? Because I know you've walked away from a lot of sales, and you've gotten a low price in a lot of things. Can you just give our listeners a feel of that?
Sure. Now, we buy most of our properties in private transactions, but we go to a lot of auctions. There are a lot of, auctions are very customary in farmland. Last fall, in the fourth quarter last year, sort of the height of auction season, we went to just over 100 auctions, and we bought 5 or 6 farms from that. We were the high bidder in a couple of cases where they decided they weren't going to sell. But what's extraordinary to me is that we were outbid 98 times. And not only were we outbid 98 times, but on average we were outbid 98 times, on average by 51% by farmers. So we see this inefficient market with very widespread in prices. We knew what our top rent is when we go in, and we're outbid by, our top bid. We get outbid by a lot. You got to look under a lot of rocks in this business, but if you do, there's still great value out there. That's why we're so excited about what we're doing.
Well, great, and we'd agree. I mean, we think farmland on its face today is a great spot to be, and if we end up in an inflationary environment ahead, which we fear, we think it's a wonderful place to be, unlike a lot of other income-producing assets such as bonds. So with that, Hunt, we'll wrap up, but thank you for your time today. We appreciate it and look forward to speaking in the near future.
Thank you, Fred.